paying cash for a car is supposed to be the best way to do it. Everyone recommends it. You've got no interest, no debt, no monthly repayment. So here are some numbers which really shouldn't make sense. On a $50,000 electric SUV and a salary of $90,000 with a 5-year term, taking out a novated lease actually works out about $9,000 better off than paying with your hard-earned cash. And that's right, not cheaper than a car loan, cheaper than handing over cash for that vehicle and being done with it from day one. And in today's video, I want to show you exactly where that comes from. It's definitely not a trick, but it's also not for everybody. So what I want to go through is 3 things that do stack up in the background. And once you can see all 3 of these things, you will understand and know whether this is something that applies to you and would make sense for you to consider further. Hey guys, if we haven't met, my name is Mitch and I cover all things personal finance, particularly those that do affect the average Australian. And in this video, I want to get stuck into the numbers that you won't see or discuss with your coworker when you have a conversation about their novated lease in the lunchroom. Before we do get stuck into it though, guys, I want to say that anything we cover in this video is purely for informational purposes only. It's general in nature and does not apply to your individual circumstances. So if you are looking at something like this, make sure to go and seek professional advice. Not my advice, not your coworker's advice. Go and see your accountant or financial advisor who can specifically tailor their advice for you and your situation. All right, guys, method number 1 is the easiest of them all. It's cash. And all it involves is getting the drive-away price of your vehicle, walking in, handing over your money, and driving out with your beautiful new car. The car is $50,000, got stamp duty of $1,400, and a Queensland registration cost with the CTP will be $782. So the drive-away price is going to be $52,182. Hand over the cash and off you go. No debt, no repayments, nothing more to worry about. All right, so you got the car home and now you have to run it. So to keep the figures all the same, we're going to run this on about a 15,000 kilometer average per year. And to do that for charging, we're going to say about $810 for the year. And then with the rego, we'll just stick with the cost we used originally. So let's say $782 a year. And that's just going to be starting from year 2. Comprehensive insurance, let's just allow $1,650 per annum. Servicing and tires, we're going to allow $493 per year. Electric cars are actually genuinely cheap when it comes to this. So the servicing costs of them are extremely minimal compared to your standard vehicles. So that's about $3,579 per year in running costs and just over $17,800 for the whole 5 years. So the total cost buying with cash and running your car for 5 years is going to be $70,075. No interest, no fees, no lender to report to, just a clean purchase. Now, I want to go one step further though, and it's something that I don't think always crosses people's minds when they come to making this decision. The $52,000 that you've just taken and spent on that vehicle, it was doing something before you did that. The moment you hand it over, then whatever it was doing has ceased. If the money would have otherwise been sitting against your home loan or sitting in, say, an index fund, then it was doing something for you. Now, just for simple numbers, let's take that $52,000 and compound that at 5%, which would be about $14,000 over the life of the 5-year term. And look, I'm not telling you what to do with your money. All I'm saying is that at the assumption of 5%, this is what you would be otherwise foregoing if you did remove that money. But I think you have to at least ask yourself these questions because a lot of people don't think into it that far. And cash is never free. Yes, you don't pay interest, but you are losing out on an opportunity somewhere by handing over that money. That loss just doesn't really appear on the invoice. And look, with that in mind, I do want you to hold on to that thought as we go through the next few options. Now, option number 2 is just take out the standard car loan, and this is one that most people would have to do. So the one in the middle is probably the one most commonly used by the everyday person. Same car, same 5 years. We're going to work it at about 9.5% interest, and we are going to leave the balloon at the end, so it is a fair fight. So you finance the full drive-away price of the vehicle, $52,182. And on that loan, we're going to say that the payment is $906 per month, and we've got a balloon of $14,459. The total interest over the term, and I'll put the exact numbers up on the screen, but it's about $16,000 that you're going to pay. And on the car loan, you're going to have those exact same running costs that the person paying cash would have had. All right, so once we add the running costs of that vehicle and all the loan repayments with the residual, you're going to land at around $86,755 to own that car. Now, that's around $16,500 more than you would be if you were paying cash. And all of it is essentially interest, as you would expect. And this is just the reality of borrowing money. It does cost. I do want you to notice a couple of things though, because they help to explain the next whole section. First thing is, when we finance the car on a car loan, we are financing the GST. Now, that $50,000 car contains about $4,500 of GST, and that is money that we cannot get back as a private buyer. So the reality is, we've borrowed that money and we've paid interest on it over the course of 5 years. And the second thing is that you've paid every last dollar of that vehicle and the running costs out of your post-tax income. That's repayments, charging, tires, servicing, everything to run that car has come out after the Australian Tax Office has already got its hands on some of your hard-earned money. So that alone is just two of the big leaks, and I want you to remember those as we go through the rest of this. Right, so option number 3, it's the novated lease. It's a pretty confusing one for a lot of people. And although I say it's confusing, let's try and simplify it. So effectively what you're going to be doing is your employer will get the cost of purchasing the vehicle and running the vehicle. They're going to take money out of your pre-tax income and pay the lease provider. And then, and only then, is the Australian Tax Office going to get its hands on your hard-earned money. So they're going to be coming to you at a lower taxable income and therefore taking less tax. Now, normally with this sort of thing, there is a catch, and it's called the Fringe Benefits Tax. And to deal with it, people use something called the employee contribution method, which means that a large chunk of these running costs and repayments are going to come out of your post-tax income, which is going to negate a lot of the benefit that you would otherwise receive. But because we're clever and we're buying ourselves a reasonably priced EV, then we're going to have that benefit in full, and we won't have to worry about the FBT. The exemption originally started with a wider range of vehicles, but it is now only for full battery electric vehicles, and they've got to be under the luxury car tax. So our reasonably priced $50,000 EV is perfect for this. So we've got no fringe benefits tax, we've got no employee contribution method, so the entire vehicle is going to be taken out pre-tax. So I want to go through a few stacks that really start to pile up and give you this big benefit. All right, so stack number 1 is that the majority of the GST is unpaid by yourself. The lease provider is going to buy this vehicle and they're going to claim back the GST. Therefore, you're going to finance the amount less the GST, which means your finance amount is going to be significantly less than someone who's using a standard car loan. Now, you're not completely free of paying GST. You will pay a small portion on the back end once you pay out the residual. So in this particular example, we're going to pay just over $1,300 in GST once we come to paying out that residual figure. The rest of the GST, you never see it. You never have to pay it. It's wiped off your bill. Now, stack number 2 is going to be your running costs are actually going to be exclusive of GST. So that's charging, insurance, tires, compulsory third party. They all go through the lease excluding GST. All right, so let's get stuck into the salary bit. So on $90,000 a year, you're in about the 30% tax bracket and you've got a Medicare levy that adds on. So let's call it 32% in total. Now, when you package this all up, the full package, the finance plus the running costs, is around $13,500 per year. And it all comes out pre-tax. So of that total package, 32% of it, you're not going to pay. So that's about $4,300 that you otherwise would have had to pay to the tax man. And total that up over 5 years, that's $21,000 that you're going to be saving in income tax. Now, it's not all amazing news because yes, just like the car loan with the lease, you've had to go and pay this off at a pretty high interest rate. You're financing a little bit less, so you're going to pay around $14,900 in interest. And not only that, you're going to pay about $1,800 in fees and sort of management fees across the life of the lease. And the reality is a cash buyer is never going to pay either of these things. So once you count the interest and the fees, the lease option is going to cost you around $12,000 more than what it would have otherwise cost the cash buy. So let's have a quick look on the screen of the full picture versus the cash option. So we've got the extra cost of the car. We're going to take $12,000 We've got the running costs, which we're going to be excluding GST, which is going to give us about a $1,400 benefit. And then we've got the income tax save portion, which you can see here is $21,000 or just above that. And then we take off those management fees around $1,800, and you can see here the net position versus paying cash, which is in excess of $9,000. So the tax saving does almost all of the work. Essentially, it's going to be big enough to pay the interest bill, cover the fees, and leave you about $9,000 better off than the person who walked in and handed over their hard-earned money. And if you think back to what we spoke about at the start, that actually is before you factor in what that person would have otherwise potentially made if they were to invest that money or gain some return elsewhere with it. But at the end, guys, I do want to go through a couple of caveats because, and please don't skip this because it does decide if this is something that you should pursue. First of all, regardless of reducing your tax, the reportable amount is still going to be at your salary. This will be reported back. It's going to affect Medicare. It's going to affect Centrelink. The other thing is that it is tied to your employment, and 5 years, at the end of the day, it's a long time. So it's a big commitment. You can't really get out of these things and have it cost you nothing. It's going to be significant early termination costs, or if you're trying to transfer it to another employer, some employers might not want to take it on. And even if they do, it's going to be, a big, process to get it transferred across. Don't just jump in the first time that you get to a new job and they've got this amazing novated lease program that you just got to jump on, because you never know, you might be out of there in the next 6 months. The other thing is that the residual figure was taken up pretty simply in this, but you still need to factor that in. So across the course of that 5 years, you really want to make sure you're putting money aside, saving for that residual. So the residual is something that you really need to understand and you need to prepare for. And the other thing is that a lot of these numbers are going to be really dependent on the interest rate you can manage to achieve. They're going to be dependent on your salary. And really, it's irrelevant if you're looking at something that's not an EV, because the figures are drastically different when you compare a novated lease on a EV versus an ICE vehicle. So there you have it, guys. 3 ways to buy an electric SUV. And I'm sure you'll agree that the outcome would have surprised many people. The standard car loan, by far the most expensive option, but surprisingly, the cheapest option when you really do the figures would be the novated lease. So really with this, guys, I want the key takeaway for people not to be that novated leases are this amazing thing and you should all go out and get them. It's just that the key benefit that is being really provided to us at the moment by the government with this FBT exemption, that's what's good. So this is something that is changing in the coming years. So just make sure you familiarize yourself with the key dates of those changes. But if you are in the market for an EV, it's definitely something worth considering if it's an option for you at your current employer. If you do want to run the numbers, I have access to a calculator that I've sort of built up. I'll put a link in the description on that. But otherwise, guys, that's really it for the video. Hope you've enjoyed it. If you have, I really would ask that you do like the video and subscribe to the channel. Otherwise, guys, hope you enjoyed that and we'll see you in the next one.